So in Chapter 10 we'll be discussing payroll taxes. So we're shifting gears a little bit, and we'll talk a little bit about the payroll tax issues mostly from the employer's point of view and their reporting obligations, but we'll also touch upon some of the payroll issues that relate to employees. As you know, we have a pay-as-you-go system in this country, so the federal government relies on this stream of funds that are sent from employers, for example, and other citizens and taxpayers who may make estimated taxes to pay current federal government expenses. So many of you have gotten W-2s from jobs you've held. This is, as you know, a summary of your earnings and withholdings. And then you'd file your tax return, Form 1040, which is in part a reconciliation device that compares your tax liability as calculated on the 1040 return with your tax payments that you've made throughout the year, either through withholdings or estimated tax payments. And you make these estimated withholding calculations in part by using this Form W-4, which the employee completes, and this is where the employee claims withholding allowances. And the more withholding allowances claimed, the less taxes are withheld from the paychecks. A couple of methods are used to calculate the withholding. The percentage method, which is a little more sophisticated method to calculate withholdings, uses a range of percentages, and automated systems and computerized application programs would use the percentage method, and then smaller employers who may not have the wherewithal to use these computerized systems may use the tax brackets for calculating the withholdings. When these taxes are withheld, there's really two general kinds of withholding for federal government purposes. Again, this doesn't include tax and others, and local municipalities and things. But at the federal level, there's the federal insurance contributions, which is Social Security, and it includes the Old Age Survivors and Disability Insurance, OASDI. That's 6.2% for the employees, and that's matched for the employer. And then the other second component is the Medicare hospital insurance, 1.45% for the employee, and that is matched by the employer. It's interesting to note that on the Social Security side of FICA, the withholding stops at $127,200. So this might be considered a regressive tax, because the wealthier folks, then those above $127,200 in earnings, would no longer have their Social Security, have to pay Social Security tax. And so yes, they'd still pay Social Security tax on the first $127,200, but then it would stop after that, after their income rises above that threshold. On the Medicare side, there is no upper threshold, so the 1.45% continues to be paid. I mentioned there is a matching, so the employer and employee pay the same rate. So it would be 12.4% total for Social Security and 2.9% for Medicare. There's also an additional 0.9% for those whose wages exceed $200,000. Here, though, the employer does not match that surtax for Medicare. That's only the employee's responsibility. For tips, employees, if they earn tips in excess of $20 per month, then they're required to, the employees then are required to report their tip income by the 10th of the day of the following month. And it's preferred that they report these tips on Form 4070 to their employer. And then employers must withhold income tax and FICA tax on these tips. If you're a large food and beverage establishment, they may allocate tips to employees, especially if they believe there's underreporting of tips. And it's generally 8% of the gross receipts is assumed to be the amount of tips. Employers are not required, however, to withhold federal taxes on allocated tips. They are reported on Form W-2. So employers must make timely payroll tax deposits from any amount of taxes that have been withheld from their employees. And so how often then the employer has to report and pay the tax liability depends upon, in part, the amount of their tax liability, and that will of course depend on the size of the company and number of employees and their earnings. So there's this look back period where you go back to 4 quarters, and for 2017 it starts on July 1st, 2015 and runs to July 30th, 2016 for wages paid in 2017. And so if the monthly amount of the tax liability is $50,000, excuse me, you must file monthly. If the amount of your tax liability is more than $50,000, then the employer must report and pay semi-weekly. So they must make the deposits if it's more than $50,000 semi-weekly. So the semi-weekly deposit schedule, so if the payroll is paid to the employees on Wednesday, Thursday, Friday, then they are required to make these payroll deposits by the following Wednesday and no later. If the payroll is paid on a Saturday, Sunday, Monday, or Tuesday, then they're due the following Friday. And they cannot write checks and pay into, for example, the IRS. They could get fined for that. The employers are required to use this electronic funds transfer payment system to make their deposits now. So if an employer accumulates $100,000 or more in the tax liability, they have to deposit that large amount by the very next banking day, regardless of the type of depositor they are. And again, here the government doesn't want employers holding large amounts of withheld wages, for example, in tax liability, and maybe earning interest on this. The federal government, especially for these large amounts of money, they want that amount deposited very quickly. If this occurs where this amount of the liability builds up to $100,000, then that employer becomes a semi-weekly scheduled depositor. And that will hold true for the remainder of the year this occurs, as well as the following year. First, in terms of self-employment taxes, they're based on the net earnings of $400 generated by the sole proprietor. So, and we talked a little bit about this back in Chapter 6. Now on the unemployment tax side, this is a federal unemployment or a FUTA tax, and it's 6% up to wages of $7,000. This is an employer tax that's the employer's responsibility, and there is a maximum credit for the state employment taxes, or SUTA, of 5.4%, and as long as that the state continues to make timely payments to the federal government, they'll get credit for the full 5.4%, and then the remaining 0.6% or 0.6% on that $7,000 is remitted to the federal government. And we'd use Form 940 to report or make these annual unemployment tax filings. After employees earn more than $7,000, then there is no, the employer is not required to pay unemployment tax on that amount greater than $7,000. This is an area, this household workers withholding is an area that's the IRS knows is often underreported. So household workers, these are often called domestic workers. They're considered employees subject to federal FICA and unemployment taxes if a couple of conditions exist. One is that the paid wages of $2,000 or more during the year 2017, if that occurs, if they had a housekeeper and they paid him $3,000 during the year, they're required to withhold for unemployment, Social Security, or FICA, which is Social Security and Medicare, and federal income taxes. The other condition is if wages of at least $1,000 were paid to all their household workers combined in any quarter in 2016 or 2017. So either of those two thresholds, if either of those two are met, then they have to withhold income, FICA, and unemployment taxes. And they'd use Schedule H, which is prepared by the employer taxpayer and submitted. They do that when they file their taxes annually. I mentioned earlier the W-2 forms are really the summary of the employee's wages and taxes that were withheld, and that's due by January 31st of the following year. And then copy A is sent to the Social Security Administration, and it must be sent by January 31st. And then this W-3 is a transmittal form that summarizes all of their employees' W-2 activity, and this too is sent to Social Security Administration. When you see a C after the W-2 or W-3, this is a corrected income tax retransmittal form, so it's the W-2 that's been corrected. And if you've had one W-2 that's been incorrectly prepared, and you really are sending a corrected statement. And the same would have to be true of the transmittal. When an employee receives supplemental wages, which is compensation paid over and above the employee's regular wages, then there's a flat tax applied against this at 25%. And actually it's calculated on one of two methods. The flat tax at 25%, and there's a problem we can go through in the subsequent video, which runs through some of the end of chapter 10 problems. Or they can combine the supplemental payments with regular wages and then calculate the withholding. So either of these two methods are acceptable for these supplemental wage payments.